Good evening. My name is Stan Freifeld, and I'm going to start the presentation now. It looks like it's about 8 o'clock. I have a lot of material to cover, so I think we should get started. I want to start with a couple of announcements. First, just thanking everybody for coming. It looks like there's a very nice turnout here. And I just, some administrative issues. I don't have my wingman with me. I usually have somebody who watches over the chat box and the question box and tells me if questions are coming in. I don't have him here with me tonight, so what I'm going to do is I'll answer questions later on, or if there are some issues that don't get resolved tonight and you want to find out more about the presentation or about the topic that I'm going to cover, feel free to call me or send me an email. If you're an options trader, I probably like to talk to you. I like talking options. Here's my contact information. The phone number, 973-362-4558, and my direct email. And to get a copy of the presentation, which will be recorded as well, but if you want to get a copy of the slides, you could go to this site. It's our site, optionsstrategist.com, and put a / and then the word early, like for early exercise, which is what we're going to be talking about. And before I begin, I just want to, we're going to have some fun tonight going through the presentation, but I just want, I want to mention some sombering thoughts about option trading in general. And that is, the truth of the matter is, most option traders end up losing money. What's the right percent? Well, the truth is, I don't really know. I've heard 80%, I've heard 85, numbers of that order of magnitude. That's a pretty large percentage of those who are trading options. I'm sure you know it's a zero-sum game. Money just flows from one pocket to another. We're not really creating anything when we're trading options. It's not like, for example, a baker who takes some ingredients and puts them into a pot. You could tell I don't know how to bake, but then stirs it all up, puts it into an oven, and comes out with a product that he could sell for more than the sum of the ingredients going in. We don't have that. Whatever you make, there's somebody on the other side who's losing. Whatever you lose, there's somebody on the other side who's making. So it's a pretty tough business. It's a competition, and I want people to think about it that way. And so to do well in this competition, we have to work a little bit harder than the competition. We have to be a little bit more motivated than the competition. And we have to be a little bit more knowledgeable than the competition. Now, the good news is that you're coming to this webinar and probably other webinars by other people, and you're taking the effort to learn how to trade options. So I think this is going to put the edge in your favor and give you a high probability of being in that 15 or 20% of people of traders that will make money trading options. Okay, so with that, okay, that's the end of my sombering comments. Let's move on and get to the presentation. Okay. Oops. All right. Oh, first, the lawyers want me to read the disclaimer here. So the presentation is for educational, informational purposes only, should not be construed as a solicitation to buy or sell options or other securities of any kind. Also, we're not advising or recommending the use of the strategies or techniques described herein. There are multiple risks inherent to options trading that may expose investors and traders to potentially rapid and substantial losses. You agree that McMillan Analysis Corporation, and especially Stan Freifeld, right, is not liable for any trading losses or other consequential damages which you may incur. And option trading is not suitable for everyone. to learn more about the risks of trading options, you should see the booklet that's put out by the Options Clearing Corporation called Characteristics and Risks of Option Trading. Okay, with that, we could move on. All right. Oh, well, before we really get into the presentation, I wanted you to, well, to see what I look like when I used to have hair. This was me on the trading floor of the American Stock Exchange. Just take 30 seconds to look through my very brief bio. And it gives you some indication as to why you might want to listen to what I have to say. I have some very good experience trading options, and I've been doing it for a long time. I was on the floor of the stock exchange from 1994 through 2001. Actually, I left on 9/11/2001, but that's another story. Okay, all right. Okay, so we're going to talk about early exercise. And first, we have to talk about what different types of exercise there are. So aside from push-ups and swimming and running, we also have, more related to options, American-style exercise. And that's when options can be exercised at any time up until expiration. And all stock options in the U.S. and a number of index options are also American style. A lot of ETFs are American style. But we also have European style options. And those are ones where the option can only be exercised at expiration. Okay, so there are other ways of getting out of a particular trade if you're long an option or short an option. We'll talk about that. But as far as exercising the option, you could only exercise at expiration. Now the other side of that means if you're short the option, you could only be assigned at expiration. Okay. Settlement, options settle to either stock or cash. Okay, and that's we're going to need to know that. You'll see why that's important later on. All stock options settle to stock. And then we also want to know about automatic exercise. At expiration, options that are in the money by a penny or more are automatically exercised. That penny used to be a higher number. I don't recall exactly what it is, but I think when I was on the floor, it started out at 5/8, and then it got progressively lower and lower until a number of years ago it went to a penny, which is where it is now. Now, you don't have to have an option exercised, even if it is in the money by a penny, but you have to call your broker and tell them. Okay, and if an option is out of the money, you could exercise that one as well if that's what you want to do. Okay, those are contrary to what would normally happen, and you have to tell your broker, but it's possible to exercise or not exercise regardless of what the automatic exercise would do for you. Okay, so how do we close a long option position? Well, there's 4 ways. We could sell the option. It could expire worthless at expiration. There could be an automatic exercise at expiration, or, and what we're going to talk about is we could early exercise the option. So if you're long calls, you have the right to buy stock if you exercise the option. And if you're long puts, you have the right to sell stock. If you don't have the stock, you'd be shorting the stock if you exercise the option. Okay? What if we're short? What if we have a short position? How do we close that out? Well, we could buy back the option. It could expire worthless at expiration. We could be assigned at expiration, or we could be assigned earlier than at expiration. That's an early assignment. If you're short calls, you have an obligation to sell stock if you're assigned. And if you're short puts, you have an obligation to buy stock if you're assigned. Looks like to sell and sell. I have too many cells here, right? I'll cross that one out. Okay. Also, what's going to be important to us when we talk about early exercise are dividends. And so I just wanted to go through very quickly issues related to dividends. I find some people get confused about this or just aren't aware yet. So there are several things that the company determines, and those are the declaration date. That's when the board of directors announces that there is a dividend. Then there's the record date. That's the date that you have to be a shareholder of record, and that's important on the company's books. There's the payable date. That's the date the dividend is actually paid out. Now, a company could go ex-dividend on a particular day. Well, we didn't define that yet, but they could go ex-dividend on a particular day, and the payable date could be several weeks later. So you might be wondering, where's that dividend that I'm entitled to? But it's probably coming. The company will announce when they're going to pay it. And then, of course, the dividend amount. How much is the dividend? In addition to that, there are two calculated dates. The first one is the ex-dividend date, and that's 2 business days before the record date. So that's important. The ex-dividend date is the day that the stock trades without the dividend. I think in Latin, ex means without. So it's without the dividend. And the reason we have to go back 2 business days is because in the U.S., as I'm sure you know, we have a 3-day settlement. So if I buy stock, let's say on a Monday, it doesn't settle until 3 days later. Okay? And then we also have the cum date. I've seen different definitions, but I'm going to tell you the definition that I'm going to use for it and that we've been using for some time. The cum date is the day before the ex-dividend date. So cum, I think cum means with, ex means without. So the stock is trading with the dividend up until the cum date, and then the next day, the ex date, it trades without the dividend. All right? On the ex-dividend date, the stock price decreases by the amount of the dividend. So if yesterday a stock closed at $75, today's the ex date and the stock goes ex for 50 cents, a flat opening is considered 74, so it would be the 75 minus the 50 cents. So a flat opening the next day or on the ex date is 74.50. So if the stock opens at 74.75, for example, we'd say the stock went up 25 cents, even though it closed yesterday at 75 even. Okay? Just some terminology and things to know. All right. Now let's see what happens when we early exercise an option or if we're assigned. So here I have an example with calls. I think the next page we'll look at puts. But we have a stock at 52. We're looking at the 50 strike, and the call is $2.50. So as you can see, there's $2 of intrinsic value and 50 cents of time premium. All right. So we go out, we buy the call. We're going to have a $250 debit. Right? If we do one contract, buy one call, $250. If we then exercise, because it's American style, it's a stock, we could exercise it right away. If we exercise it right away, we're going to have to pay $5,000, the strike price times 100 for 100 shares, another debit. And then if we sell the stock, we're going to get $5,200 for it. Now we ended up paying $5,250. We're only going to get $5,200. So there's going to be a loss of $50. So this early exercise tells me that I'm going to lose the time premium. Remember, it was $2 of intrinsic value, 50 cents of time premium. I'm going to lose that by early exercising. All right, so right away we know, well, we want to be careful when we early exercise that there's not too much time premium because we're going to lose that if we early exercise. All right, what if on the other hand we're assigned? So we went out, we sold a call, now we took in $250. When we sell something, we take money in. We're assigned, which means we have to sell stock. So again, money's going to come into our account, 5,000. And if we want to close out that position, we're short now 100 shares of stock from the assignment. We have to buy stock. Well, the stock is trading at 52. We see that here. So we have a debit of 5,200. Now we have a gain. So an assignment, if there's time premium, is a good thing. Now, of course, we can't control when we're going to be assigned, but an assignment when there's time premium, an early assignment, is probably a good thing for us, whereas exercising an option early, if there's time premium, is probably not so good. We'll go into the details, but so far, this is what we see. All right. What about puts? Well, puts, it's really the same thing. We have a stock at 47 now. We're looking at the 50 strike. So the put is $3 in the money. We have 25 cents of extrinsic value. $3 of intrinsic, 25 cents of time premium or extrinsic value. So if we buy a put, we're going to have to pay a debit of $325. If we then exercise the put, it gives us the right to sell stock. So we're going to sell 100 shares at 50. We're going to take in a $5,000 credit. And then to close this position, we're going to have to buy the stock back, which is trading at 47. So there's a $4,700 debit. Net, we put this together, there's a $25 loss. Again, we're losing the time premium. So it doesn't matter if we're talking puts or calls. If we early exercise an option, we're going to lose that time premium. All right, same thing over here. I'll just run through it quickly. If I sell the put, I'm taking in the credit of $325. If I'm assigned, I have to buy stock, right? When you're short a put and you're assigned, you have to buy stock. So I'd have to buy $5,000 worth of this stock, and then I could sell it at $4,700. So I have a credit of $4,700 plus the $325, that's $5,025, and a debit of $5,000 for a net of a $25 gain. So just like we did with the calls, there's a gain if there's time premium and we're assigned on an option position. All right. Now, I'm going to go through a derivation of when it makes sense to early exercise calls, and then we'll do puts. But first, we need some definition. So C is a call, S is stock, D is a dividend, I is going to stand for the cost of carry, and it's equal to the strike price times the risk-free rate times the amount of time to expiration. The time is shown in years. Okay, so this is, well, we refer to it as cost of carry, but strike times risk-free rate times time. And right now, the risk-free rates are very low. Although yesterday, I guess they went up a little bit, but we'll see an example. And P is the corresponding put. So we have a call, and we have the corresponding put. Okay, all right. Now, this derivation, I've come up with this derivation. I haven't seen it shown quite like this anywhere, but I know that my derivation is good because the results of what I'm going to show you are well known, or pretty well known, I guess. So follow what I do here. I'm going to start out saying I don't have any position at all, and I could refer to my zero position as being long a call and short a call. Then I said, okay, when do I want to early exercise the part that I can, the long call? I want to exercise it when it will turn my position from being worth nothing, zero, to being worth something. So I'm going to say I'm going to exercise the call. I still have the short call, and now my position is greater than zero. And what I'm trying to do is figure out what the criteria is to make this early exercise to give value to my position, which wasn't, it was worth zero before. All right, so what happens when we early exercise? Well, a few things. When we early exercise, a call, we're going to get stock. If there's a dividend, we're going to get the dividend. But we have to, we're going to have to carry, that's why it's called cost of carry. We're going to have to carry the stock from now until expiration, when the call would have expired. So, and we still are short the call. Now, for those of you who are familiar with synthetics, let's see what happens here. I'm just rearranging. I just moved the C right over here. So I have stock. I'm long stock. I'm short a call. Plus I'd receive the dividend minus the cost of carry. We want that to be greater than 0. Now, what do we know stock and a short call is synthetically equal to? Well, it's a short put, right? For those who are familiar with synthetics. And if you're going to trade options, trust me, you should be familiar with synthetics. You know, there are some things that I think every option trader should be familiar with. Synthetics is one of them. Put call parity is one. The Greeks. I'm getting a little carried away, but anyway. So synthetically, long stock and a short call is a short put. And what I'm going to do now is I'm just going to put the short put over to the other side of the equation. And the resultant formula I come up with is that the dividend minus the cost of carry has to be greater than the put. When this is true, I will have gained value by early exercising my call. Now let's take a look. Let me put up a few of these here. So this is what a timeline would typically look like between time 0 and expiration. Okay. Now, if there's a dividend, the dividend trades with the stock all the way up to the cum date, up to and including the cum date, right? After the cum date, there's no longer any dividend. All right, so for an exercise to make sense, we already determined that we want the dividend minus the cost of carry to be greater than the corresponding put. Well, if there's no dividend, if this is a 0, well, 0 minus I greater than put, when could that happen? Well, never, because the cost of carry, especially in today's environment, very, very low, but it can't be 0 or negative. So this equation will never, D minus I being greater than put, will never be true if there's no dividend, if D is equal to 0. So if there's no dividend, you never should exercise. Now, you know, I always hate to say never. I've been around a long time doing this. There are some times when perhaps it might make sense anyway. And that's when the market makers aren't really giving you a good fill when you're trying to get out of the position that you have on. Maybe you want to sell and they're just not giving you a good fill. But generally, there's no reason to early exercise when there's no dividend. Now, what if there is a dividend? Okay, we have the dividend all the way up to the cum date. We have a dividend here, and then after that, it becomes 0. Well, we want the dividend minus the cost of carry to be as great as possible, right? So the dividend is here from time 0 to the cum date. So certainly we're not going to early exercise after the cum date, and we also want I to be as low as possible, because we want this term D minus I to be as great as possible. So we want D to be we want D to be there, right? And we want I to be as low as possible. So when would that be? Well, I gets lower as we go forward. So we want it to be at the time when there is a dividend, and then as soon, you know, the latest time that it would make sense to early exercise. We wouldn't want to early exercise here because now I is high. So we want I to be lower. I is getting lower, lower, lower. And then at this point on the cum date, D minus I is going to be the highest that it could be because we have the dividend, and I is going to be the lowest value it could be during the time that we have the dividend. Okay? So if there is a dividend, then we only really need to check on the cum date. So it's pretty straightforward when to early exercise a call. It's on the cum date. We don't have to check before. We don't have to check after because the dividend is gone. So it's pretty straightforward. And here's the test. D minus I and has to be greater than the put. Now what do we use as the put? Remember, the call is going to be deep in the money for this to make sense. And the put might be as low as 0. It might be a nickel. It's going to be very, very low to begin with. And we typically look at the bid price on the put, okay, where you could sell the put. So it might be 0. It might not be 0. But we'll look at an example or two coming up. All right. So now that you know how to do it, we could do the same thing, perhaps a little more quickly with puts. Yeah, the same definitions here, put, stock, dividend, cost of carry, and the call. And we'll start out with no position, and my no position is long a put and short the same put. We want to know when we could early exercise to give value to the position. Okay. Well, what happens when we exercise a put? Well, we're short stock. If there's a dividend, we have to pay it. And now we have to carry, we're going to get, instead of having to pay to carry stock, we're actually going to receive interest on it. The interest that you receive when you're short stock is referred to as a short stock rebate. And it's usually at a rate less than what the risk-free interest rate is. So in today's environment, I don't think anybody actually receives a short stock rebate. When I was trading on the floor, and I think we used to pay 5/8 of a point, and the short stock rebate, what we'd receive was 3/8, something like that. You know, it's a long time since I've been on the floor, over 15 years. But the point is, in today's environment, there's no short stock rebate, but theoretically, interest rates are not always going to be where they are, so we want to know how to handle this when interest rates do go up as well. All right, so next step, whoops, get rid of that. I love this tool. Okay, so I just brought the short put over to the next to the short stock. And again, if we remember our synthetics, short stock and a short put, what is that synthetically? Well, we know it's a short call, right? So I'm replacing these with a short call, and then we'll come up with our formula. The resultant formula is cost of carry minus the dividend has to be greater than the call. So it's a little bit different than what we had for the put, but you'll see the implementation is a little bit more complicated. With the call, we only had to look on one day, right? We only had to look on the cum date. Here we have, well, the same picture. For an exercise to make sense, we need the cost of carry minus the dividend to be greater than the call. If there's no dividend, well, then you really always need to check. And that doesn't mean every time that you buy a put, you have to say, gee, every day, do I early exercise today? Do I early exercise tomorrow? Do I early exercise the next day? No, remember, this is only when the put is very deep in the money, because you're going to lose any time premium that there is. So if it's not a deep in the money option, well, then it's no issue. You don't even have to be concerned. But if it is a deep in the money put, yeah, then you want to check. You want to see if it makes sense. And what if there is a dividend? So if there's no dividend, you quote, always need to check. If there is a dividend, what we want to do then is wait until the dividend goes away. So we have the dividend from time 0 all the way up until and including the cum date. On the X date, there's no dividend anymore. So now it's as if there was not a dividend, and now we have to check again all, theoretically all the time, but only if we have a deep in the money put. So the way I have it here, kind of like a flow chart, if there is a dividend, you check on the X dividend date, and then we go back to number 2. So now there's no dividend, so we'll always need to check. Okay, so that's when we check and how we check. Let's see. Let's see what kind of impact the risk-free rate has on early exercise. So here's a situation. We have a stock at 60. The 50 strike. We're looking at the 50 strike. The dividend is 20 cents, and there's 30 days to go. The bid on the put is 0, maybe a nickel, a very small amount. In this case, it actually could be more than that. But the call is deep in the money. You could see we're $10 $10 of intrinsic value right away in the price of the call. Now, it doesn't even matter what the price of the call is. You can see I don't even show it here. Now, when I put this together, I was using, because I did the presentation about a year ago, I was using a risk-free rate of 15 basis points. Up until yesterday, I was using 35 basis points, and now I'll have to determine what to use, but probably somewhere more around 50, maybe a little bit more, 50 basis points. But in any event, this is how we do the calculation, which is what I want to show you. The cost of carry is equal to the strike price. Remember, it's XRT. Okay, well, the strike is 50. The risk-free rate that I was using at the time, 15 basis points, 0.0015, and the time in years is 30 days over 365 days. That's the portion of a year. If you multiply this out, which I've already done, we get a penny. And so in the case where the dividend is 20 cents, we have D minus I, that's going to be 19. Well, that's an exercise. So we're going to go ahead and exercise this option on the cum date. Okay? Now, let's take a look. If interest rates were higher, and when I was trading on the floor, interest rates were, the risk-free rate that I'm talking about was 5%, and then it went up much higher than that. It was 9.5%, 10% as the risk-free rate. And interestingly enough, and this goes back to the late 90s and beginning of 2000, I remember guys who were more senior, who had been on the floor longer than I had been, saying, gee, I don't think interest rates will ever go down from where they are. And me, I'm just thinking, gee, it seems interest rates are probably cyclical. They have been in the past. They probably are. So interest rates probably will go down. So hearing everyone talking about how interest rates are going to stay up and then watching them actually come in as much as they did and stay where they were for such a long time, it was kind of eye-opening to me. But anyway, so with interest rates at a higher rate, higher than 15 basis points, let's say at 6%, for example, well, we'd calculate the cost of carry now this way. We'd say 50 times 0.06 times 30 over 365. Well, that comes out to a quarter, 25 cents. And so D minus I in this case, 0.2 or 20 cents minus 25 cents is negative a nickel. And that could not be greater, well, it's certainly not greater than 0 or 5 cents. So in this case, we don't exercise. Okay, so that's what we're comparing. We're comparing what we get over here, these numbers, to the put. So in the first case, we exercise. In this case, we don't. And here's the bottom line. Calls are more likely to be exercised in a low versus a high interest environment. For puts, you could work it the same way. I don't think I have a slide on this, but it's the same, go through the same kind of exercise, pardon the pun. But And you'll see puts are less likely to be exercised in a low versus a high interest environment. So right now, we're in a low interest environment. Calls are, likely to be exercised. And what that means is if you're short the call, well, you could probably expect to be assigned. Now, of course, you could, if you're short a call, you could go through this calculation and determine if you should be, or if it would make sense for the other side to exercise. And if the answer is yes, then you should expect to be assigned. And if the answer is no, then you should expect not to be assigned. Although you never know. People do strange things, and they might exercise for the wrong reason. But we'll see that that's actually going to be something good for us. Well, we saw already that that's a good thing if we're assigned when we're not expecting to be, because we're going to gain any time premium that's left in the option. All right. Now, why would somebody? Oh, I thought there was. Yeah, okay, I almost missed this. This is another slide talking about the time to expiration, right? We just saw the impact of the risk-free rate on early exercise. What about the amount of time we have to go? Well, do we exercise the call on the cum date? Let's check it out. So again, we have the stock at 60, strike is 50, dividend 20 cents. Now let's just look at the higher interest rate. Interest rate is 6%, and the put is still minimal, 0 or nickel, something like that. Well, if there's 7 days to go, this is on the cum date, right? If there's 7 days, then we calculate the interest, same way, 50 times 0.06 times the period of a year, seven days now over 365, comes out to 6 cents. And so the dividend minus the cost of carry is going to be 14. That's certainly greater than 0. It's also greater than a nickel if it's a nickel. It's also great if it was 10 cents even, it would be greater. So in this case, we would early exercise. But what if there was more time to go? We're at the cum date, but the option that we're long has 30 days to go. Well, we calculate it this way, same, just to replace the 7 days by 30. Now we come up with a quarter. Well, if we put the quarter into the equation for I, we have d minus I, again, is negative 5 cents, and negative 5 cents is not greater than either of these two. So in that case, we would not exercise. All right? So what we could glean from this demonstration is that near-term calls are more likely to be exercised than far-term calls. And near-term puts, again, I'm not showing that. You could prove it to yourself, though. Near-term puts are less likely to be exercised than far-term puts. All right? So now we know when to early exercise. We know the criteria. Why would somebody not early exercise when the rules, the formula says that we should? There's money in it. It's a financial decision, right? And the reason I have this, by the way, is because when I do a presentation on dividend spreads, I haven't done a webinar on that, but I teach it in my mentoring program. We want to take advantage of the fact that there are times when traders should early exercise, but they don't. And I've asked lots of traders, why didn't you exercise that option? And here are some of the answers that we get. First, they don't know the criteria. They didn't come to my webinar, or they didn't read the rules in a good options book. All right. They don't have the capital. They think they can't early exercise because they just don't have the capital to support the purchase or sale of stock. They're not aware of the dividend. Now, I think brokers are getting better at letting their customers know if they're long a stock or short the stock, that there's a next date coming. So they should be aware of the dividend, but not all brokers do that. And the broker has no obligation to do it, by the way, but but I know a lot of brokers are starting or have started to do it. How about they forget? You know, you're out doing something else, you're golfing. Remember, it has to be done on a particular day. For calls, it's only on that CUM date. If that date goes by, well, you're out of luck. Now, here's one. This is kind of interesting. They've already made a profit. So had someone tell me, well, he bought this option for, you know, I don't, let's say $2, and it's now worth $5, and he knows if he early exercises, he could take in the dividend of, you know, a quarter. So it's just not worth it. You know, I already made a lot of profit. I like having this on. I said, okay. Now, that's not the right thing to do because they could always exercise the option, then the next day reverse it and be in the same position they were just in, but be a quarter, you know, $25 richer for every contract they have. So there might be, well, and this might make sense, commissions and expenses involved in the early exercise, and if you want to get back into the stock, the buying it back or selling it out, depending on if we're talking puts or calls. So there, you know, there is maybe a little validity to that, although you know, commissions these days are relatively small. When I first started trading, you know, I was on the floor, so commissions weren't, they were pretty small for me at that time. But in other accounts that I had, outside accounts, the expenses were huge. It was very expensive to trade options years ago. And what about this one? It's part of a spread. I don't want to exercise my option because it's part of a spread. Well, to me, I never really understood that because remember, this option is deep in the money. It's got a delta probably very close to 100, 97, 95, 97. Might even be 100. And so by exercising, what are we getting? Well, we're getting stock, either long or short stock, which has a delta of what? 100. Stock is always 100. Long stock's positive 100, short stock negative 100. So it's not really affecting your position, and you are, or at least not very much, but it's, if anything, it's affecting it in a positive way, and you're receiving a dividend, and then tomorrow reverse it if you don't want to keep the stock position. So, and then we have the gain from exercising is small. This is probably the only reason that I would say has some real validity to it. You know, if the difference was, you know, 2 cents or something really small. Now remember, 2 cents is really $2. If you have 50 of them, that's $100 just for doing the right thing. Of course, then there's some expenses to go against it. It might just not be worthwhile, or some might think it's not worthwhile. Oh, actually, yeah, none of these except maybe number 8 should really keep you from early exercising. All right. Now, what about assignment risk? You hear people talking about assignment risk, right? Well, the truth is you should, based on what we just went through, you should know when to expect to be assigned, but you don't find out about the assignment until the next day. So at that point, you might need to take some immediate action, but there's not really much of a risk. Yes, you might have to scamper, you might have to get out of the stock or sell the stock or buy the stock back, you know, whatever it is. But as far as your position, it's probably not a big deal because, well, for the same reason I said before. Your option position was probably had a delta close to 100, and now it's replaced by stock, which also has a delta of 100. So it's not really a big deal. And here's the interesting thing. If you're assigned when you're not expecting to be, in other words, if you did your homework and you checked to see, gee, a dividend's coming up, will I be assigned? And you say, gee, no, according to the formula, I'm not going to be assigned. And then you are, that's probably good for you. It's not bad. Okay, that's a positive thing. You have to look at that. If somebody just handed you some money, they did the wrong thing, and they've given you some free money. Of course, you know, you have a little bit of of excitement because your broker might call you and say, gee, Stan, you don't have enough in your account to cover that. So you reverse it. There's no penalty. You just have to reverse it the next day. And so there's going to be a small commission cost probably. But all right, now there is a real assignment risk. So what I was referring to, what I called assignment risk, wasn't really a risk, right? It was almost a good thing if we're assigned and we're not expecting it, and if we're assigned and we are expecting it, not really much of a big deal. However, there is a real assignment risk, and that's this. If it's part of a spread and you're dealing with cash-settled American-style options, then you could have a real risk. Now, luckily, there aren't too many. In fact, OEX is probably it's the only one that I know of that trades with any with any amount of liquidity. There might be a couple of other very, very small ones, but remember, it's American style. You could exercise at any time or be assigned at any time. And in addition, it's a cash settlement. Now, here's the thing. A question that I typically ask people, what is the delta of cash? We already said the delta of stock is 100, right? And I say, well, what is the delta of cash? And lots of people say, well, the delta of cash is also 100. But it's not. Cash doesn't have a delta, or you might call it zero. The example I use is if I had $1,000 in the bank and IBM goes up $1, how much money do I have in the bank? Well, it's probably still $1,000. All right, but let's look at this example. You'll see what happens. So it's with OEX. OEX is the index that represents the S&P 100. Okay, it used to be very, very popular. Now it's overtaken more by SPX, the S&P 500. But in fact, it was so popular, it actually stands for option exchange, OEX. That's what this symbol means, option exchange. But when I put this together, again, probably about a year ago, OEX was trading at 895. And let's say a trader is long the 865, 890 call vertical. If you're assigned on the 890 calls on these guys, so we're long the vertical, that means we're long the 865 call, we're short the 890 call. If we're assigned on the 890s, the position is still going to be long the 865 calls, but now we're also going to be short $500. If the next day, if OEX tanks, the calls fall, and the dollars don't give us any kind of a hedge. So our hedge has been taken away from us in this case, and that's a real risk. That's something you have to be prepared to encounter if you're going to trade spreads on OEX. Now, of course, it was realized that that was a problem, and so the CBOE came out with another type of option, XEO. It's OEX backwards. And XEO is settled. It's also settled in cash, but it's European style. So you don't have to worry about an early assignment. Okay? All right. There's one more interesting thing. I want to tell you about a trading disaster. This is a true story. I changed the numbers around a little bit, but the actual numbers were actually much larger than this. But here's what happened. Stock, and I don't want to mention what it is, but some of you could probably figure it out. But the stock was trading at 183, and a trader bought 100 of the 181, 182 call spreads for 90 cents, expiring a week later. So this was on a Friday. A week later, this was going to expire. Okay, now of course he's paying 90 cents for a $1 vertical, so he's risking 90 cents to make 10 cents. You might say that doesn't make a lot of sense to me, but maybe it does. The stock was at 183, and he was sure it was going up from that point. Okay, so he needed it to be above 182 to make the full 10 cents 100 times, which would be $1,000. Here's what happened though. On the following Thursday, the stock went ex-dividend for 85 cents, and he finds out that he was assigned on the 182s, the 182 calls, right? On expiration Friday, the stock, it did what he wanted it to do. He wanted it to be above 182. It was actually at 185. On Friday, he exercises his 181s. All right. Now think about this. I'll wait for a minute or so, or half a minute. I'll let people think about this. Ignoring commissions and exercise, all fees, exercise and assignment fees, which are typically very low. But how much money did this trader make or lose? I'll give you a hint. He ended up losing money. Okay, so the stock did what he wanted, but he was assigned. So I'm going to have a sip of water while some of you think about this. All right, some people are sending in responses. I see somebody saying that he lost 75 cents. So are you saying, I guess you're saying that would be $7,500, right? $75 100 times. Well, okay. Anybody else? Somebody here is saying he lost $1. Oh, someone's saying he lost $1.90. All right, well, let's take a look. Let's take a look. The cost of the trade was $9,000, right? We know that because he paid 90 cents 100 times. So $90 times 100, that's where the $9,000 was. All right, now the trader was hoping that the stock would stay above 182 at expiration, and therefore he would make the 10 cents, right? It was a $1 spread that he paid 90 cents for. He was hoping to make the additional 10 cents, which would be $1,000. But here's what happened. He wasn't aware of that 85-cent dividend. So being assigned, he had to pay out the dividend, and that cost him $8,500, $85 100 times. Then on Friday, he ended up making his 10 cents, which is the $1,000, but his net loss was 7,500 bucks. So very good. Yeah, there was somebody who said that. Very good. Oh, actually, yeah, someone I know, David. Hi. David, very good. You figured out exactly what happened. But this is a trading disaster. Now, the actual example was much larger than this, but not knowing that there was a dividend really cost this guy, who became a student of mine. It happened to him, and then he became a student. Should have been the other way around. He should have been a student first, and then maybe this wouldn't have happened. But anyway, but was there anything he could have done? Let's take a look. Was it avoidable? Yeah, the answer is yes. First, he could have he could unwind the position on Wednesday, or he could have exercised his calls, right? But he didn't know about the dividend. I mean, that's what the real issue was. But when he found out about the assignment on Thursday, it was too late. There was nothing he could do at that point. Or as I say, his fate was sealed. And it was an expensive lesson. Hopefully, nobody listening to me now is going to make that kind of an error. So that's what you have to be careful about, those types of things. All right, so here's some final thoughts I just want to say about this. To sum it up, for long call options, we only need to check for early exercise on the COOM date. And we already know how to do it, so I won't repeat that. For long put options, we only need to check for early exercise after the ex-dividend date, if there was a dividend. If there's no dividend, then we always have to be careful if we have a deep in the money put. In the money short options can be assigned at any time. I'll tell you something. I've had a lot of experience with this. I've been assigned, at least one, it might have been twice, but I know at least once, I was assigned on early on out of the money puts. And you'd think, why would anyone, you just never know what's in anybody's mind or what they're thinking. And if you're lucky enough to get that assignment, somebody's giving you some free money. And this is the last thing, or the next to last thing that we just looked at. Be very careful if you're doing spreads with cash-settled American-style options. I say like OEX. It's probably only OEX, the only one that most of us would even consider, because the other ones don't have any real liquidity. So you'd probably want to consider XEO instead of OEX. Okay, so well, now I'll tell you a little bit about the company, McMillan Analysis Corp. That's where I work with Larry McMillan, and we have lots of different products and services. We have trade advisors. We have 3 newsletters. We do money management. If if options are just too much, if you don't want to get involved, but you like the idea of being in the option space, we could do it for you. We have lots of educational material. We have software products. We have an option calculator, an expected return calculator, a probability calculator, lots of different things like that. And we do consult. Actually, these are the 2 things. I should have made this one in red too, but these are the 2 things that I do. Consulting to groups, to institutions, hedge funds, and individuals. And what really got me started with Larry was the one-on-one mentoring. I decided after I left the floor on 9/11, 2001, that instead of just trading in an office by myself, I wanted to trade, but I also wanted to show others and teach others how to trade. Coming from a very noisy and busy environment, going to an office that's kind of lonely was, it was kind of sticker shock for me. So I decided to set up a mentoring program. I called Larry, who I didn't know at the time. I knew of Larry, but I didn't know him personally. And I said, let's get together for lunch. He said, sure. And that was 11 years ago, and we've been working together since that time. So if you're interested in any of these things, you could visit our website. You could call me. I told you I like talking to option traders about options, and it's always fun for me. Now, for coming and listening to my my webinar, we have some specials. If you go to the site, you'll also get a copy of this PDF if you want a copy of it. Just go to optionstrategist.com with a / in the word early, for early exercise. And what else? Oh, yeah, recently, actually within the last couple of months, I arranged with OptionView to get a 30-day trial. They give trials through other groups, but it's normally for 2 weeks. We work with them. You can get a 30-day free trial, no credit card or anything, just and you get full use of the program. We also have something called the Option Workbench, which was put together by a former student of mine. It's really a very, very nice product. And you could get a 30-day free trial of that one as well. Again, no credit card or anything else. Why not, well, whatever you're using, why not take a look at these and see if they would serve your purpose. And so if you're interested in the mentoring, that's really, that's really my baby. Call me or just look at the mentoring tab on our website, optionstrategist.com, and then / the word mentoring. Or call me, or and then here's the answers to the brain teasers that we had at the beginning. It's interesting. Sometimes I get more questions about the brain teasers than I get regarding the material that I present. But it's 2 3/4. The time would be 2:30 p.m. and you'd call the lady mom or mother because it's your mother. Okay, and so I always, for those who might have come a little bit later, I always have some brain teasers that I set up before the webinar start, just to give people something to look at instead of a sign saying, the show will begin soon, or words to that effect. And then here's my contact information. Now I do see there's a few questions that have come up. Let me just see if I could address them. The ones that I can't address right now, I will get back to you, because I'll have your email through the registration, and I always respond to every question. Let's see. Well, there's a couple of questions about the interest rate. The rate that, some people use different types of interest rates. I've always used approximately what my broker pays on money that's sitting around in the account. It's the risk-free rate. And it probably changed yesterday, so I'll probably have to change it. But it was at 35 basis points. It's not a great place to keep your money in a brokerage account if they're paying you that kind of return, when you could certainly do better in other places. Let's see. Actually, John, you asked a very good question. That might be, somebody's asking, if you're assigned on the OEX 890 call, why would you be short $500? And actually, John, I think you're right. It wouldn't be, it wouldn't be 500. You'd be short some amount of dollars. Yeah, you're right. I'll have to change that, John. Good point. Thank you for pointing that out. Yeah, interesting how I just kind of went through it without thinking about it. Yeah, I really appreciate that. Let's see. How do we ensure? Okay, I'm not. Well, there's a couple of questions. I'm not sure exactly what they mean. I'll get back to. If I don't answer your question now, I'll get back to you and ask you more about it. Wondering if you will distribute the slides. Okay, well that's easy. Yeah, just go to optionstrategist.com/early, and the slides will be there. This is also being recorded. I think it'll also give you a link to the recording if you want that as well. And someone says, when does it make sense to buy back options that you've sold? I'm not sure exactly what you mean by that. If I sell something for $3 and I could buy it back for $1, then it would make sense to do that. I might think that maybe it's going to go back up in value. I sold something for $3 and now it's less than $3. I'm going to buy it back and capture a profit. So. And then John, it says, can we find the brain teasers anywhere? I got here on time. Yeah, John, if you just take a look at optionstrategist.com/early, you'll have the all the slides, and the first one has the brain teasers. Okay. All right. So that I see there's a few more questions. Some are actually so long I can't digest it all right now. I'll look at it though, and I will get back to you. So thank you all very much for attending. I hope you found it useful, and good luck with your options trading. All right. Have a good night or a good day, depending on where you are, and I'll see you at the next webinar. Bye-bye.